Ever wondered how a small team buys a giant company with very little of their own cash? That's the power of leveraged buyouts. We'll explore LBOs, their structure, benefits, risks, and successful versus challenging real-world examples. An LBO, or leveraged buyout, is when a company is acquired primarily using a significant amount of borrowed money. The assets of the acquired company often serve as collateral for this debt, essentially helping the purchase pay for itself. Acquirers, typically private equity firms, first identify target companies with stable cash flow or untapped potential. Next, the acquiring firm puts in a small equity portion, usually 20 to 30%, with the vast majority coming from debt financing. After acquisition, the firm actively works with management to boost profitability, cutting costs or expanding market share to increase value. The ultimate goal is an exit, typically within 3 to 7 years, by selling the improved company for a much higher price, generating substantial returns. A key benefit is magnified returns for investors, as debt amplifies the percentage gain on their smaller equity investment. Moreover, going private removes public scrutiny, letting management focus on long-term value creation and strategic improvements. However, LBOs carry significant risks, mainly the high debt burden, which makes the company vulnerable to economic downturns. Even a slight dip in cash flow can make it incredibly difficult to service the debt, potentially leading to financial distress or bankruptcy. Consider Dell Inc.'s 2013 LBO. Michael Dell took the company private to transform its business model away from public market pressures. This strategic move allowed Dell to successfully pivot to enterprise solutions, pay down debt, and later return to public markets with greater value. In contrast, the 2005 Toys R Us LBO faced immense challenges, burdened by debt in a rapidly changing retail landscape. Despite efforts, the heavy debt load, combined with intense online competition, ultimately led to the company's bankruptcy. These examples highlight the dual nature of LBOs: powerful for value creation, yet precarious with high leverage. We've explored leveraged buyouts, where companies are acquired mainly with borrowed money, seeking to boost value for high returns. LBOs offer immense profit potential through leverage and operational improvements, but come with substantial risks, demanding careful execution.